This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, May 5th, 2016. Euro dollar. So there are signs of a top in the euro after the market stalled out at 116.17 this week to post a fresh 2016 high. Clearly looking back over the past several weeks and months, the market has shown some strong resistance up towards the 117.09 August 2015 peak. And so with the market running a little bit overbought this week, that stalling out was somewhat anticipated ahead of this latest minor pullback. From here, there's risk for additional downside as the market shows signs of topping out, but we'll need to see a break back below 112.17 to really take the immediate pressure off the top side. Sterling dollar. So cable had traded up to some key medium-term resistance or short-term resistance, short to medium-term resistance in the 146.70 area this week before finally taking that level out. But as you can see here, the market was unable to establish a close above 146.70, which ultimately keeps the pressure on the downside for now. At this point, there's still risk for additional weakness, but at the same time, if we do see a break back above 146.70, it will do a good job of suggesting that the market is carving out some form of a base off those 7-year lows that were seen back in February ahead of the next major upside extension. So right now 146.70 is that key level to watch above, while the market holds below, the bearish structure still remains firmly intact. Dollar yen. So dollar yen is showing signs of a bit of a bounce out from those recent multi-month lows that were set just shy of 105 this week. At this point though, it's very difficult to say that the market is ready to trade much higher with the downtrend still firmly intact. Any rally should be very well capped with only a break back above 111.89 to really compromise the immediate bearish outlook. At this point, there is still risk for additional downside towards and through those key psychological barriers at 105. Euro Swiss. So Euro Swiss continues to trade mostly sideways, though the market has been slowly grinding higher and is looking to establish back above some key short-term resistance at 1024. A break above that level would open the door for a retest of the recent multi-month highs at 112 further up. But if we do see any setbacks, they should be and are expected to be very well supported down towards and ahead of 108. Aussie dollar. So Aussie has pulled back in recent trade after recently putting in a 2016 high at 78.35. At this point, there are signs of the market carving out a top, but now we want to pay attention to that next key level of support at 74.15 below. I guess a break below 74, that figure, would do a good job of officially shifting the structure and putting the pressure back on the downside, while in the interim, while we hold above, the market could be looking to maybe top out, but put in another higher low somewhere, see a bit of a correction higher ahead of the next downside extension. Dollar CAD. So dollar CAD has seen an impressive recovery out from its fresh 2016 lows at 124.61, with the market now trading all the way back towards next key resistance at 29.90 in the form of that high from the 18th of April. A break above 29.90 would really be required to force a shift in the structure and take the immediate pressure off the downside, while inability to do so does suggest that the market could still be poised for additional weakness. But again, over the past couple of days, we have seen some impressive strength, which could be warning of a more significant base in this pair. Kiwi dollar. So Kiwi continues to show signs of being very well capped on rallies above 70, with the market this week stalling out just shy of that previous 2016 peak that was set back on the 19th of April at 70.54. At this point, the market could be poised for fresh weakness, but we would need to see a break back below 67.59 to really strengthen that outlook and accelerate declines. SPX 500. So the S&P 500 is showing signs yet again of stalling out above 2100. The market had done so after putting in a record high back in sort of the summer of 2015, and then again stalling out below there and above 2100 back in November of 2015. So once again, we could be seeing the market stall out here ahead of the next major downside extension, but it's going to take a break back below 2021, that low that was seen back on the 24th of March, to really strengthen this outlook and accelerate declines. Gold. So gold is looking increasingly constructive as the market breaks higher towards and stalls just shy of that key 2015 peak at 1307. But any setbacks now should be very well supported, with the market eventually favored above that 1307 high and towards the 1400 area further up. If we do see any setbacks over the coming sessions, they're expected to be very well supported into the 1225 to 1245 area, while ultimately only back below some previous resistance now turn support at 1190 would really compromise the newly adopted constructive outlook for gold.